Myth number 5, the government can solve its financial problems by raising taxes. Well, it turns out the government can't raise taxes at all. It can only raise tax rates. Taxes are what happens when the tax rate the government imposes interacts with people's behavior. This is perhaps the most interesting picture in all of economics. And it's interesting precisely because it's so boring. What you're seeing here is federal tax receipts. This is all tax revenue from all sources combined: payroll taxes, income taxes, estate taxes, tariffs, everything. Federal taxes, all sources combined, as a fraction of GDP. And what you see is from 1950 up to the present, this has remained relatively stable at about 17%. That is, over time, if you think of the economy as a pie, the government has collected a constant 17% slice of this economic pie. Now, let's superimpose on top of this, for example, the top marginal income tax rate. So back in the 1950s, the top marginal income tax rate was north of 90%. It dropped in the 1960s, reached an all-time low during the Reagan years, goes back up during Bush the first, comes back down, goes back up again. This is the top marginal income tax rate. So we talk about taxing the rich. This is the rate that applies to the rich. But notice what happens here. In years in which we taxed the rich at a very high rate, the government collected 17% of the economy as tax revenue. And in years in which we lowered the tax rate on the rich, the government still collected 17% of the economy as tax revenue. And the same is true of, for example, the capital gains rate. When capital gains taxes were particularly high, the government collected 17% of the economy as tax revenue. When capital gains taxes were particularly low, the government collected 17% of the economy as tax revenue. The same is true of the average effective corporate tax rate. When corporations paid higher fractions of their profits to the federal government collected 17% of the economy as tax revenue. When tax rates on corporations were lower, the government still collected the same 17% of the economy as tax revenue. It didn't matter whether we taxed the rich or capital gains or corporations. It didn't matter whether we taxed them a high amount or we taxed them a low amount. Regardless of what the government has done, historically, it has consistently collected the same 17% of the economy as tax revenue. Now, you might say, all right, but we're looking at tax revenue as a fraction of GDP. Tell me what's happening to tax revenue straight up. So let's look at what happens to tax revenue as tax rates change. What you see here is the top marginal income tax rate. This is data from 1940 to 2015. So across the bottom, as we move to the right, we're taxing the rich at a higher rate. As we move to the left, we're taxing the rich at a lower rate. Up and down, we're measuring tax revenue per person 1 year later. So this is total federal tax revenue on a per capita basis 1 year after the tax rate goes into effect. And this is all adjusted for inflation. The story we hear when we hear things like, well, we need more tax revenue, so we need to tax the rich more. Implicit in that statement is, as you increase the tax rate on the rich, we will collect more tax revenue. But if we actually look at the data, what we see is a different picture. The actual data looks like this. On average, as we have increased the tax rate on the rich, 1 year later, the federal government has actually collected, on average, less tax revenue. There are exceptions to this, but there's also a very clear trend that the tax revenue moves in the opposite direction that we think it should. And this is not just true of the top marginal income tax rate. We also see it if we look at the capital gains tax rate. Now, the relationship here is not as tight, but it's disturbingly in the same direction. On average, as the government has increased the capital gains tax rate, 1 year later, it has collected less tax revenue than it did before. We see the same phenomenon with the corporate profits tax. We see the same thing with the estate tax. In fact, of all the federal taxes, I'm only aware of 2, which historically, as the government has increased these tax rates, its tax revenue has actually gone up. And those 2 taxes are Social Security and Medicare. The disturbing part of this is these are the taxes that fall most heavily on the poor and the middle class. Myth number 6. The rich aren't paying their fair share. What constitutes a fair share? What you see here is average market income of various income groups in the United States as of 2013. So we have the poorest 20% of Americans at the top. Their market income, that is income they earn from participating in market activities as opposed to money the government gives them. Their market income is about $15,800 on average. Here's the middle income Americans. Their average income is about $53,000, and the top 1% just over $1.5 million. So let's ask, what is a fair tax rate for these people to pay? And as we talk about tax rates, let's talk about effective tax rates. And what I mean by that is, after you have done all of your legal and accounting gymnastics and write-offs and deductions and exemptions, when all that's finished, what fraction of your income did you end up paying to the IRS? That's the effective tax rate. So we can argue about what constitutes fair. A lot of people tend to answer the following way. The poor should probably pay somewhere around 2%. A lot of people think that middle-class Americans should pay around 15%. And a lot of people think that the top 1% should pay around 30% of their income as taxes. Now, we can argue about whether these things are indeed fair, but these seem to be numbers that lots of people will tend to agree with. So let's look at what these groups actually pay. If we look at the federal taxes collected from each of these groups, we see something like the following. The average household amongst the poorest 20% of Americans pays, on average, $800 in federal taxes. The average middle-income household in the United States pays about $9,000 in taxes, and the average household amongst the top 1% pays about $500,000 in federal taxes. Now, this isn't the end of the story, because we don't just pay money to the federal government. The federal government also gives money back. A lot of this comes in the form of the Earned Income Tax Credit, or Social Security benefits, or unemployment compensation. But all of these things are instances in which the government has first collected money and then turned around and given the money back. So let's account for this, and economists call this transfers. Transfers are money the government gives to people. The average household amongst the poorest 20% received an average federal transfer of about $9,600 in 2013. The average middle-income household received about $16,700. The average top 1%er earned about $800. Most of that is likely coming from Social Security retirement benefits. But notice what happens now. If we calculate the effective tax rate by accounting not just for what people pay to the government, but for the money the government pays them back, what we find is something astounding. We claimed that a fair tax rate for the poorest Americans is 2%, and a fair tax rate for the top 1% is 30%. If we run these numbers, what we find is the poorest 20% on average are actually paying negative 56%. That is, when all the dust settles, they're actually receiving more money back from the federal government than they paid in the first place, making their effective tax rate below zero. This is true all the way up through middle-income America. The average middle-income American is receiving back 15% more from the federal government than he paid in. The top 1% are paying about 34%. And here we have an interesting conclusion. On average, and there are exceptions, but on average, only the top 40% are net payers into the federal government. And this raises an interesting point, because every time someone says, well, we should cut taxes, someone else responds with, well, you mean tax cuts for the rich. But in fact, our tax system, at least at the federal level, has become so progressive that virtually every tax cut, by definition, is a tax cut for the rich, because on average, those are the only people who are actually paying.